Hey there, everyone. Dave Keller here with StockCharts.com, and welcome to this special edition of The Final Bar. We're on the road this week to Texas A&M, speaking at the university today at an event co-branded with the CMT Association. We're super happy to support the CMT Association, really helping to elevate the discussion of technical analysis in the financial industry and more widely spread. And also Texas A&M, which was the first academic partner with the CMT Association, actually offering scholarships to students at the Mays Business School to take the CMT exam. So we wish those students taking the exams here coming up very soon the best. And today we're going to do a special mailbag edition of The Final Bar, answering some of the questions that we received. As a reminder, when we have a live show, we have a chat going, and always drop your questions in there. We gather them every day, and we put them in the mailbag for special episodes like this. Also, of course, our email is always a good idea, thefinalbar@stockcharts.com. And of course, just drop a comment below the video you're watching on our YouTube channel. By the way, don't forget to like and subscribe to this video while you're here. Before you forget, that would certainly help us out. So today from a rainy College Station, Texas, here's a special edition of The Final Bar, Mailbag Edition, and let's get to question number one. Dave, do you think there needs to be a news catalyst, or will buyers suddenly appear when the markets hit that magic number? I really like this question because it really gets to the information, or I guess the behavior behind the charts, right? We spend so much time talking about technical analysis, talking about particular trends, talking about the shape of the S&P 500 and how it's evolved here over the last year or so. But at the end of the day, what I always try to think about are these flickering ticks. These price bars represent millions of individual investors, financial institutions, advisors, companies, endowments, all coming together and buying and selling shares of things for different reasons, right? And I would say arguably one of the most important reasons is their mindset. And so, when I think about what causes the market to move, personally, I would say it's less about news. It's less about, Powell making comments in a press conference this week that caused the market to drop very quickly because he implied that rates might, continue to be elevated, or that keeping the door open for future rate hikes. At the end of the day, it's not Powell's comments that moved the markets. It's people's reactions and interpretations and emotional sort of byproducts of those comments that Powell made. So I would encourage you to think less about what events cause this move, what catalyst, but more how individual investors, how market participants interpret and anticipate the potential impact of those comments. That's really what's moving the markets. Having said that, I would say there's always this balance between, fundamental drivers of, and maybe think of it as three ways, right? Fundamental drivers, which would be companies, right? Alphabet announces blowout earnings, Apple misses earnings, that, Disney, decides they're going to get out of the theme park business, right? Those sort of news events have the possibility to move stocks. And if individual stocks get moved enough, it has the possibility of certainly affecting the larger benchmarks, right? Because it's a market of stocks, right? Individual companies that comprise those indexes. So that's one kind of general bucket of things. And I would say, particularly with the Magnificent Seven, because of their weight, I would say a potential catalyst could certainly be big earnings. And I would say the fact that Apple's earnings came out last week, not particularly strong, pretty much since that sort of initial rally at the end of last week, we've sort of stalled out since then. And I'm wondering if maybe the realization has kind of been baked into the markets, perhaps. The second general item would be macroeconomic factors, right? If there was news that events in the Middle East escalated in a significant way, and certainly it's a volatile situation and a fluid situation at the moment. But let's say there's a big news event, right? Some other players are drawn into the conflict. The U.S. gets directly involved, and those kind of things would certainly affect the markets very, very quickly and significantly, I would argue. Then there's this third bucket called, which the financial media usually just calls technical factors. And anytime you hear that keyword, that basically means we can't come up with a reason. No one really knows why the market's moving. But what you have to remember, and I remember talking with Jay Woods about this on the floor of the New York Stock Exchange, we're always looking for that reason why markets move. Sometimes they just move. Sometimes there are more buyers than sellers. Sometimes people are excited or nervous, and something that happened a while ago, it's like, I think, to be honest with you, maybe one of the big reasons why we saw this V-shaped behavior in the markets over the last couple of weeks was the market sold off, made a new swing low, got down to 4,100. The S&P became oversold. I would argue that at least the beginning of that rally was more of a technical reason. It was more just a reaction to the fact that it's oversold. What's beautiful about the way that the financial markets operate in a free market system is when they get too high or too low relative to what they should be, and that is that's tough to pin down what it should be. But again, the whole idea is of being overbought and oversold is we're above sort of the normal reasonable level for that thing, or we're below that reasonable level for that thing. So in reality, I would say all three of those are potential drivers. So does there need to be a news catalyst? I don't think so, because the way I would see it is, if the market moves higher from here, it moves higher. But if rates remain about where they're at some point, the market becomes so strong in the face of clearly not strong or not bullish evidence, right? Evidence that really suggests growth stocks should be weaker rather than stronger, that at some point, I would say the market sort of leans a little too far over the skis, and that's when you sort of have a drop back down. So I don't think there necessarily needs to be a news catalyst, but those would be the general areas that I would be look for. And I think certainly with the, with Powell's comments this week show you how quickly one comment from a Fed chair or from a Fed governor certainly has the possibility to move markets. That's my long-winded answer of saying maybe, and I think that is the reality of the markets here in 2023. Let's get to question number 2. Dave, which of the predefined point and figure scans should I use to create a bullish percent index for the London market? So first off, I love the initiative that you appear to be taking, trying to create your own bullish percent indexes. I love it. So let me just point out where you're, and just sort of take everyone on this journey with us, show us where, or show them where we're talking about here. So on Charts and Tools, which again, if you're kind of newer to the StockCharts platform, I would spend some time on this page because it really shows you the breadth and the depth of the StockCharts platform, and probably some areas you're not familiar with. And this is a really good place to just sort of figure out what's what and where you might want to focus your attention. But if we go here in the right column down to what's called the predefined scans, which are down here under reports and more. So our scanning engine is pretty powerful, and I would say one of the great features of the StockCharts platform is the scanning engine. These are a series of scans that you can run, some really customizable scans that you can implement to understand a particular area of the market that you're focused on and identify opportunities. And in this environment, I think it's all about finding those opportunities, finding those insurance stocks that are running while everything else seems to be languishing. That's the game, I think. We do have some predefined scans, and if you're just learning the scanning engine, I actually had a question just last week of someone who said, I was just learning how to do scans, like, can you give me some ideas of where to start? I pointed them to this page because what you can do is actually look at these scans. This is a predefined scan of stocks making new 52-week highs. I can see 149 names currently being returned, and these are the different markets with which they come from. And if you click on one of these, it'll show you the results, and you can save it to a chart list, or you can edit the scan criteria. So what you can basically do is take one of our predefined scans, start with that as your building block, and then customize it further from there. So if you just want to know the potential and just start to get some ideas about where you could customize your scanning a little bit, this is a really good place to start because we've kind of done the busy work for you, and it'll help introduce kind of the syntax for you too. It's it's something you need to get a little bit used to. Now, what you're referring to are the bullish percent indexes, and another StockCharts function now I will show you is if we go here to Charts and Tools, and we go to the market summary, you want to go to table view, and if you scoot all the way down here, you will see this group of indexes called bullish percent indexes. So this is a methodology that was created years and years ago by this guy, Abe Cohen, who ran a firm called Chartcraft, really pioneers in point and figure analysis, I would argue. And he came up with this idea of the bullish percent index. And what it basically does is it looks at a group of stocks like the S&P or the NASDAQ 100 or whatever, and it looks through all 100 or 500 charts and counts what percent of them or how many of them are in a bullish phase versus a bearish phase. And so these are things that we actually calculate every day. We have this database going back pretty deeply. So these are all pre-canned ones that we have. So these are all the ones that we currently have available. You were asking about doing it on a different market on London, which we actually don't track a bullish percent index for London just yet. So could you do it? You could, but it would be a very manual process. It's not as simple as you probably would think, unfortunately. Now, what we do is we actually do what's called the double top breakout and the double top breakdown, or double bottom breakdown. Those are the indicators that we use. So a double top breakout is a classic buy signal where a column of X's goes higher than the previous column of X's. That is the basic buy signal within the point and figure methodology. But what a bullish percent index does is it basically says for every chart, what was the most recent signal. So it's not necessarily what just happened today. It might have happened yesterday or 2 weeks ago or whenever it was, but we basically say what was the most recent signal. So you could run this scan every day. You could look at the results and then create your own database of which ones, just so you could track the most recent signal for every one. But that is a painstaking process. So that's how you would have to do it. I would not enjoy that process myself. So the good news I'll tell you is we are building out our breadth database. This is a good one. I actually shared this with our database team. So we'll take a look and see how we can include these. But we are definitely looking at breadth and sentiment indicators, seeing what we have available. We have a ton of breadth indicators. It's in a lot of different places. We're looking to aggregate it. Hopefully we have a breadth homepage to share with you at some point very soon. And we'll look to add some more breadth indicators as well. If there are other breadth indicators like this, by the way, that we don't have or that you can't find that you think we should have, would you let me know? And by let me know, I mean hit our support desk because that's how we track those requests. Click help and it'll say contact support. Do that and just let them know what breadth indicator you're looking for. And that'll help us prioritize how we're adding some of these new features. Great question. Number 3. How do you interpret the advanced decline data? Today there were 1,275 more decliners than advancing stocks. Isn't this an important sign of weakness in the overall market? Really interesting question. Okay, so what we're going to do is bring up my breadth indicator chart list, and I'm going to go to this one. So this isn't showing the exact data that you were referring to. You were actually showing the number of stocks advancing and decliners. I usually look at it in percentage terms. So I have this chart that I created a while back, and what it basically is the advancers on the New York Stock Exchange as a percentage of the total listings, and then the decliners as a percentage of the total listings. You just use this syntax that you can see here at the bottom. Ticker number 1, the colon, and then ticker number 2. And if you use that syntax, you can do a quick percentage very easily. So I do this, and I like looking at a histogram just to show, all right, how many stocks are up versus down on a particular day, but as a percentage, because this was something I was looking at for 80 and 90% up days, right? When 80 or 90% of the New York Stock Exchange stocks are up or down on a particular day. That's a methodology that a number of people, I remember Paul Desmond of Lowry's talking about this. Walt Deemer, I've talked to a number of times about that as well. So I was just kind of experimenting with this years ago and just set up this chart to do it. So what I think you're referring to is probably this. I don't remember exactly when this question came in. I apologize, but I'm thinking it's one of these days when it was over 70% decliner. So if you look at what's happened, right, you had this, distribution phase in the end of October, this down wave. Then we turned very quickly at the end of October, and then first week in November, rallying very quickly. And this was last week. With the Fed meeting, Treasury auction, we kind of pushed higher. And then this week, we're kind of stalling out here between 4,350 and 4,400 on the S&P. But, a lot of up days where the advancers are outnumbering decliners by far, right? Because most stocks in the New York Stock Exchange are up because it's a big up move, right? But if you look what's happened here toward the end, you're starting to get these days where there are a lot more decliners than advancers. So what does that mean? The fact that you've rallied up here, the market is sideways, but there are way more decliners and advancers. I would agree. I don't think that's a particularly strong sign. What's interesting is, in general, when the market's moving higher, there are more up stocks than down stocks, or more advancers than decliners. That makes sense. In a down market, there's more decliners than advancers, usually. When there's a disagreement, a divergence, that usually tells you that the price is not reflecting the reality of individual stocks. And I think it's also really helpful when you have a consolidation. When the market's sideways, the price action is kind of in equilibrium. So are there more up stocks or down stocks? I can tell you maybe a little about the underlying sentiments. The fact that there are a lot more down stocks than up stocks over the last week, I think tells you the market's actually in a weaker position than it probably would suggest on the chart. Now, the other way you can look at this is by doing the cumulative advanced decline line. So what these lines do is it actually takes that daily advanced decline data and then adds the net change to a running total, and that becomes a cumulative advanced decline line. And so now you can start to look at the trend and the AD lines over time. And one of the things I noticed, look at the S&P sort of moving higher, advanced decline lines all moving up here into early November, but then look what's happened here in the last week. You can see the AD lines have all gone down, and that speaks to that previous chart where there were way more stocks down than up. I would argue that is sort of a bearish short-term signal that you have a lot more down stocks than up stocks. So I would agree with, I think, the essence of your question. I think it is a sign of weakness, certainly in the short term in the current market here. Next question. Is NMR a failed cup and handle? Great question. Actually, this is Nomura. I've not looked at this one recently, so let's take a look here. I think what you're referring to, and I would probably tend to agree, is this a failed cup and handle? I believe what you're referring to is this right here. I'm going to kind of draw that line. I'll make it a little thicker. So a cup and handle pattern is where you have a run higher usually, and then you have this rounded bottoming pattern like this, and then you have a little handle. So the only thing I would say about this that tells me, I don't know if I would agree that, is the handle usually should be a much shallower thing. Think of what a coffee cup actually looks like. You have the big cup and then the little handle. This is kind of like a big cup and a big handle, so it looks less like a cup and handle than I probably want. It's not the most ideal pattern, but I think the essence of it is right, which is we have this clear level of resistance. Whether or not you label this a cup and handle pattern, it is a resistance level, right? Around 425 or so. We broke out, and then about a week later, we're rotating lower. And I would say absolutely that is a failed breakout, no matter what. Is it a failed cup and handle pattern? Maybe. I'm probably less married to that particular labeling, but I would suggest this is a stock that broke out that now failed. And, I think that tells you it's cause for concern on this particular stock because, you want breakouts to follow through. When a stock breaks out, what you're then looking for, because now you're trading at a higher level than you had for a year plus, you want to know that additional buyers are coming and actually pushing the price higher. In this case, that didn't happen. So I think it's a bad sign for Nomura. I think it's also a negative sign for the markets, more broadly speaking, or certainly for financials, the fact that stocks that have good setups don't work, right? In bullish market environments, breakouts get bought because people are excited to put on additional risk. They want to lean into what's working, and they want to ride stocks going higher because they think the market as a whole is doing fine. When people are selling breakouts, that means, broadly, that means that they're less optimistic. They see a stock breaking out and they're thrilled to take some profits and actually have some gains at a time when it feels like that's not happening. And as a result, the breakout fails. So I think stock charts like this do not make me particularly comfortable about the condition of the markets here in the fourth quarter of 2023. Great question. Next one, is there a scan we could run on SPY and QQQ stocks for bullish and bearish divergences? So the short answer on that one is no. This is like a scan-heavy mailbag edition. The short answer is no, you can't do it. Could you do something like that? You actually could. I can't share this with you because I haven't really created it at the moment, I don't think. Let me look at my scans here really quick and see if I have like something that's close to it. But what you can actually do is a lot of the indicators actually allow you to make comparisons. You can say, where is the price now versus something else. So, like this, for example, let's see what this is. Yeah, so like this scan, for example, is looking at an indicator called OBV, on balance volume. And it's basically saying today's on balance volume is greater than yesterday's. Let's see. And yesterday's on balance volume is greater than 2 days ago. 2 days ago, on balance volume is greater than 3 days ago. 3 days ago is greater than 4 days ago. So literally, it's just that is the very simple way that you tell our scan engine, I want something where the on balance volume has been going up for the last 5 sessions, is what you're basically doing there, right? Just doing a bunch of comparisons over the last couple of days, and the only things that come back are the ones where the on balance volume has been going up. So could you do something like that and say, I want, charts where the price has gone up in the last, 10 days or 20 sessions or whatever, and RSI has gone down, was lower than it was 20 days ago. You could do that and that would work. The only issue I have with that is the problem is you have to come up with a very particular time frame. You have to say 10 days or 20 days. And divergences are actually a very visual form of analysis. So it actually might be a couple days or a couple weeks or even a couple months. And it still will look like a divergence to you, but it might not be returned on the scan engine just because you have to come up with a specific one. That is something that is more of a visual scan. I have seen firms try to do image recognition and more complicated features to try to come up with that sort of divergence. It's really hard. It's way harder than you think. That's one of those things where humans are really wired to detect patterns, and computers are not naturally wired to detect patterns as well as humans are. We're just better at it, to be honest, and to make comparisons and come up with relationships. That's why I think humans still have a place on this planet for quite some time. So the short answer is no, we don't have that exact thing. Could you build something to get you close? I think so. I would say that's going to give you a list of things, and then I would definitely go through the charts manually to see visually if it really looks like a divergence to you. But that's how I would try to do it. If you run into that trouble using what I've shown you here and trying to create that scan, just hit our support desk, and they could probably point you to some resources to make it a little easier for you. Great question. Next one. When you mention the final bar, what's the time frame of that bar? It's a really good question. As I mentioned, I'm here in College Station, Texas, and I spoke to technical analysis classes yesterday. They actually teach technical analysis at the business school, which is really, really cool. And it was great to talk to students about, who are going into, energy trading and investment banking and other parts of the financial industry or financial advisory and other things, just showing them the markets through the lens of charts and talking about strength versus weakness and supply and demand and fear and greed and really looking at all of that. So we actually had that. And the reason why I'm going through that, we actually talked about this exact thing. I sort of explained why this show is called The Final Bar and how we actually make the comparisons. For me, generally speaking, it's usually the daily chart that I have in mind because that's most of the charts I look at. I often look at like a 2-year daily chart of a stock. So if I bring up a random stock like an Apple, I'm always looking at the current bar. And, it's great on StockCharts. It's actually highlighted in green or like in yellow, depending on what kind of data you're bringing in, I think. But it highlights the bar when it's open, when the market's open. And I love that because it just draws your attention to the final bar, the current bar, and then you look to the left. So it really depends on what, periodicity you're using. So if it's a daily chart or a weekly chart or a monthly chart, then it's the most recent day or week or month. On an intraday chart, it would be the most recent, bucket of time, whatever bucket you're looking at. But for me on a daily chart, it's the daily bar, and then you look left from there. And again, the point of that is we don't want to look at a chart like you would read a book in English, which is start at the left and go to the right. Because if you look at what happens when you do that on most charting platforms, including StockCharts, you're looking at the company, you're looking at the ticker, and then all of a sudden you're thinking about Apple. And then as you're looking at this chart, you're looking at the chart of Apple. What you want to do is start on the right, where it's just price, and you want to analyze the price and think about where we're at relative to where we've been. And then after you've done all this analysis, then look to see what the company is, right? Analyze the price and then compare that to your feelings or your fundamental thesis on something like Apple. That is a better way of approaching technical analysis, in my opinion. That's how I would use things using the final bar methodology. Next question. IWF versus IWD shows investors are still not rotating into defensive sectors. Would you agree? Yes and no. Yes in that, and let's bring up that ratio, by the way. I have that on the Mindful Investor Live chart list. I have this one called Growth versus Value, and I'm actually using these ETFs, IWF versus IWD. So this ratio basically is growth versus value using the Russell 1000 growth and value ETF. So if the line is going up, growth stocks are outperforming value stocks. If the line's going down, value is outperforming growth, right? Or growth is underperforming value. So into the end of last year, value was outperforming growth. In 2023, except for this brief period over the summer where they were in line, overall it's been growth over value in a big way. And it's fascinating to me that that has been happening at a time of rising interest rates and relatively high interest rates compared to the last couple of years. So would I agree that investors are not rotating into defensive sectors? Certainly. And if you look at the relative strength of, the XLRE, and that's this one. Actually, I'll tell you what, I'm going to use a different series of charts that are really cool. This is part of the monthly chart review that I do with my Market Misbehavior Premium members. We go through this set of charts, and this is a focus on relative strength. So here's like real estate. This top series is a weekly chart. This top series is the relative performance of real estate versus the S&P. The XLRE, right, underperforming in 2023 in a big way. The XLU underperforming in 2023 in a big way. The XLP underperforming in 2023 in a big way. Those are your defensive sectors. So would I agree people are not rotating into those sectors 100%? Now, where are they rotating? There are only a couple sectors that actually the relative strength line is going up in 2023, and it's essentially technology and communication services. Now, why is this happening? Well, the XLK, about 50% of that ETF are two stocks, Apple and Microsoft. In the XLC, about 50% of that ETF are two stocks, Alphabet and Meta. So these names, these mega cap growth names, are doing very well. And that is what is really in no small part propelling those two ETFs, those two sector ETFs to dominate the others. I would argue, while there is certainly an argument to be made about the fundamental strength of a company like Microsoft, right, making new highs, I would also say that might be the defense of 2023. This idea of our investors rotating to utilities, it feels like kind of an antiquated way of thinking about rotation, because what are the blue chip kind of Pepsi, Walmart, established, stable, and not going anywhere types of companies? It's Apple, Microsoft, Meta, and while Alphabet, certainly while they have risks to their business and antitrust legislation, all that, at the end of the day, they're fairly stable and they're probably going to be here in a couple of years. And as a result, I would argue there is a rotation to defensive positioning, but it's in growth sectors like tech and communication services. But I can't disagree. The rotation to traditional value has certainly not happened in this year. Next question. Carter Worth uses the 150-day as opposed to the 200-day as his main moving average. Can that be helpful? I know Carter and I know his work very well, and I would say, there are people that are very passionate about a particular moving average setting. Carter talks the 150-day very well. I get the argument for it. His part of his argument is it's a little quicker than the 200-day, which isn't wrong, and he'll show you examples of where it lines up very well. And I don't want to disagree with that. I think that's fine. I use the 200-day because most people do, and I use the 50-day because a lot of investors, particularly O'Neill investors, William O'Neill investors, business daily type investors, focus on the 50-day and the 10-week moving average. So my argument for using the 50 and the 200-day is because that's what a lot of other people do, and I like looking at things that I know a lot of other investors are looking at as they are making their investment decisions. My goal is to get inside the head of other investors, try to understand their motivation, and try to anticipate what they're going to do next. And by looking at some of the things they're looking at, I think that helps me make that assessment. The 150-day is a lot less common, as is the 100-day and the 425-day or whatever other combinations that I've seen people throw at me and tell me are really, really important. I would argue, and this is maybe a controversial statement with my peers in the industry, I think it's less about what particular moving average setting that you use, and it's rather the fact that you have a setting that you use consistently and with a great amount of discipline. If you have an imperfect moving average, but you use it very consistently, and you use it as a money management tool and as a way to manage risk, even if it's not the perfect moving average, even if it's the 123-day, which makes no sense for any particular reason, but you follow it diligently, I think you'll probably do better than if you use the perfect moving average, but you use it haphazardly. And I think that's where a lot of investors unfortunately come out. So I'm fine with that, and I've met with Carter many times, and I've seen his work, and he does great work, and I think that's totally fair. And I like how he uses the moving averages to portray stocks in different phases, and I think I'm able to do that with the moving average combinations I have as well. That's my answer to the question. Next one. What do you do with a stock like AJG? This is AJ Gallagher. I mean, hopefully just own it. Hopefully you bought it a long time ago and you've been very patiently and happily walking this uptrend. AJG is an insurance company. When you look at the financial sector, the KIE is the insurance ETF. When you look at the financial sector, most things are struggling quite a bit. If you look at like banks, KBE, KRE is the regional bank ETF, and these are things that are kind of in downtrends below a downward sloping 200-day moving average. You compare that to insurance, which is, is this the best chart I've ever seen? No, but is it holding up while most things are not? Yeah, particularly in the financial sector. So insurance has been the place to be in that sector for sure. What's great about a chart like AJG, and again, I always tell people, if my 7-year-old son Henry, I've shown him charts and said, hey Henry, is this going up or down? And he'll look very quickly and say it's going up. So I like charts that Henry would say are going up, but let's put a little more rigor behind that comment, right? What are the technical criteria that would help you classify this as a bullish chart? I think that's what's more important going forward, so you can identify the next couple Arthur J. Gallaghers going forward, right? So what is it? So number one, we're making higher highs and higher lows. Most recently, we had sort of this little consolidation here in September and October. We broke out to the upside, pushed above 240. We're above two upward sloping moving averages, which is really important, particularly at a time when most stocks are not. The RSI has been in the bullish range for most of 2023, certainly since the first quarter, meaning on pullbacks, the RSI has generally remained above 40, a bit of a hiccup there in May, but overall you can see we've remained above 40 on pullbacks. That's usually pretty bullish. It's overbought right now, which would mean, is there a chance for a brief pullback? Certainly. The relative strength is very strong. And so I think those are the things that make a chart like this a positive chart. So, I would always call this sort of a long and strong up and to the right type of chart, but think about the technical criteria that would help you validate a chart like this. And again, stocks above two upward sloping moving averages in general tend to be pretty good long-term bets. And when that stops being the way you can describe that chart, that's when I would stop following this trend to the upside. So for at this point, would I still be holding this? I certainly would. Certainly at a time when most stocks have been struggling, a chart like this is a rare find and something to keep on. Final question, and I love the honesty and simplicity that our mailbag had when you sent in the question, is the bear market over? That was it. Simple question, is the bear market over? I would love to tell you I can answer that very, very quickly. I can't though. So here's my somewhat nuanced answer to that. Is it over? I don't know. I mean, so number one, it depends on what you're talking about. Is this a bear market that you're talking about? I don't know if I would call that a bear market. I would probably call this a corrective move. And is that corrective move over? And I think that's probably what you're talking about. Because I don't know if you would call 2022 to 2023 a bear market. And maybe that's what you're talking about. But is this sort of bear market over? Is this corrective phase over? And in my opinion, not yet. We're really close. I mean, this week it looked like we might do it. It apparently does not seem to be playing out that way here Thursday into Friday. This is a trend line that I set up using the July, August, September highs. Look at how beautifully that lines up with literally this week's high for now. Not yet. The S&P is still below its October high, around 4,400, and that was the level we kind of talked about, as the market bounced off of those lows. Look, if we can get above the October high, that would mean a higher high, and then you'd be looking for a higher low, and that could be a very constructive development. But until you break above that trend line resistance, I don't think you can say it yet. The RSI stalled out for now around 60. That's where it tends to stall out in a bearish phase, right? You have these counter trend rallies. The RSI hits 60, and that's about it. So I'm not ready to declare this bearish phase over. There are plenty of my peers and others on social media, calling people complete idiots if they're not completely bulled up at this point. I would disagree respectfully. I would disagree based on the weight of the evidence. I'm just not seeing the evidence that tells me that main medium-term time frame is bullish yet. Could it go up? It sure could. But for me, it's all about identifying the level and then validating the breakout. And I'm just not seeing it yet. It could be through the end of the day, through next week. You could certainly see it, but I'm not seeing it yet. Maybe a larger question is this larger, is this a bearish phase that's over? Is that the low? I would probably say so. I mean, I don't, at this point, given where we're at, I don't see a scenario at this point where we undercut the October low based on the dynamics that I'm seeing. I mean, the long-term time frame is still bullish for me. And that's this indicator here, just showing the strength of the trend. We get back to a negative signal, and I will be happily sharing further downside targets, including a potential retest of the October low. But for now, I think it's worth just focusing on the short-term rally within a medium-term downtrend, which I would argue still in place. And my conversation with Tony Dwyer, with Tim Hayes, those are some really good conversations over the last week or two where we talked about interest rate environments and what that means for stocks. I think Tony Dwyer's comments on liquidity were really well put about what that means for risk assets. It's not particularly a strong environment for risk assets, despite what the short-term rally has maybe suggested. That's it. That's our special mailbag edition here for Friday, November 10th. Wish you guys well. Thanks so much for flexibility this week as we traveled, come down to College Station, Texas to support the students here, to support the technical analysis community with the CMT Association. Have a great weekend. We'll be back with a live show this coming Monday. For StockCharts.com, I'm Dave Keller. Be well, stay safe. Have a great weekend.